This is Peter Tchir. He's the head of macro strategy at Academy Securities. Peter, the headline of your latest note is that there are headlines you won't see, and your first line is about the doom in the gloom. Why has the media gone so dark on markets in the economy? Now, of course, you're not talking about us here, Peter, but elaborate for me, please.
Yeah, it feels to me that the media, particularly the mainstream media, has been sending a message out that there's constantly doom and gloom. We're not really looking for the bright spots. And I think, you hear a lot, oh, this rally's only based on the Fed. Actually, I think this rally's been based on, one, beating the virus or at least making progress against the virus, and the start of this reopening. And I think this reopening is going to surprise people to how successful it can be.
Peter, I like this. It's a refreshing note. We've been talking about some of the same thing here. I was talking about this morning. How can we attribute everything to the Fed when bond yields haven't moved since March 9th? In fact, they're higher. I mean, the whole Fed thing is that yields go lower so valuations can go higher, but that hasn't been the case.
Right, and even if you look, what was happening at first is you kind of had, let's call it the work from home stocks did really, really well. Amazon today, right, all-time highs. They're selling off a little bit. I think you're now going to start seeing this rotation away from this work from home into, hey, what if the economy starts reopening? So I really like energy. I like financials. I actually like small caps. And we're going to have to see some progress on that reopening. But I think that's the next rotation. So when you look at what stocks have done, there has been some rational thought. There has been picking of winners and losers. And I think that will continue. So this is a real market. It's not only Fed driven. Clearly the Fed has helped, but there's more going on. And I think people are going to be surprised once again how positive it can be.
So based on what, Peter? I mean, this is the question where some will say, hey, it's doomy and gloomy, but it is kind of doomy and gloomy. We're still stuck inside for the vast majority of Americans. Shale companies are still going bankrupt. We just had another one this week with Chesapeake, and the evidence right now seems to be that there are still a lot of problems. So what is the evidence that maybe we should be optimistic on some of these industries?
I think when you go and take a step back, right, I spent a lot of time going through the various COVID pages that each state has, right? Each state have their own dashboard. Some are very well done, some not. Look at Texas, phenomenally well done. They're tracking, and they make it very public, how many hospital beds they have, how many are available, ventilators. So I think people are pretty prepared for this opening. Texas is supposed to start opening next week. They only have 5,000 COVID cases in Texas, right? So I think people are going to open up to this. People are going to be a little bit more willing to shop and do things that people realize, and that feeds on itself. I mean, the first thing we really need to do is get people out driving, get energy prices moving again. There's a lot to go on, and people are just, I think, too fixated on the negatives and not enough on the pockets of victory away from the really good news of the Gilead.
So right now, the catch for this is if you're trading the overall market, you're trading at a higher multiple than anything that we got in the bull market. I guess one explanation is we can just push out the earnings and say, forget the 12-month, let's look at the 24-month PE. But is that part of your point, Peter, that you have to look for the areas that have not been part of the frothy comeback?
Yeah, so for me, I'd be rotating out. I sold out of all my QQQ about a week and a half ago. I've been adding XLF, XLE, IWM. So again, energy, financials, small caps, looking at even some value shares. So I think that's where I want to be. I don't want to go all the way down to some industries I have more questions about their ability to return. I want things that kind of benefit from that first wave where, okay, hey, maybe we're not going to continue to see 4 or 5 million job losses. Maybe we're going to start seeing people come back. And to me, financials and energy really benefit from that immediately and don't have the pressure. Plus, I think, USO and some of these ETFs really distorted what was going on at the front end of the energy market. And, it's probably not a coincidence that some ETFs now no longer have any June contracts, they only have later contracts. Guess what? Today June's up and everything else is down. So these ETFs in some spaces, particularly energy, became the tail that wagged the dog. As they clear out, we'll get a better picture of what's really going on.
Yeah. So you're saying don't run to cruise lines and don't load up on airlines. Is that right?
For me, I think the risk reward there, I'm always trying to balance, coming from the credit side and fixed income side. I'm really always first think about what's my downside from here versus, what's my upside. And that's why I've kind of fixated. I think energy and financials have a much less of a downside risk. Probably not as much upside as some of those if you get them right, but I'm not prepared to go there yet.
Peter, what kind of data do you think we need to see for investors to have more faith in a group like banks, though? I mean, the only real period in which some of these cyclical value companies did well was like a flash in the pan in Q4, and that really ended in December. It was like 2 months where we got a taste of this, and we did see inflation climbing. We saw great housing numbers. We saw great consumer numbers. If that's what it took then, what's it going to take now?
So one, I think stability in markets helps the banks a lot, right? There was a lot of talk and a lot of fear. Oh my gosh, the credit losses the banks are going to take. The banks are not going to take many losses or any losses, or certainly nothing significant on the corporate credit side of things. Mortgage refinancing kind of died. It's been active, but probably not as active as it should be given where rates are. People weren't prepared. People can't do it. So you'll see transaction volumes, I think, pick up. You'll see banks make money there. And the big hole or, big question mark has been what happens on the mortgage side? Will people pay their mortgages? And I think that's always a little bit of ability to pay and willingness to pay. There's kind of been this view, I think a lot of people hold that, hey, I don't have to pay my mortgage right now. I'm getting forbearance, etc. I think you just need a small sniff that, hey, the economy can turn around, jobs will come back, and all those overhangs for banks, I think, go away very quickly. It's in the insurance industry. I think that's where the surprise comes in, and it's really a psychological turn. Do we get back to the highs? Probably not, but can we pick up another 10 to 15% pretty easily? I think much so there than some of the big tech, which is already priced in, as we're seeing.
Is this a much slower grind then for the S&P 500 if you don't have the mega caps pulling the weight?
Yeah, I think it's going to be a very slow grind. Even when I look at the technical side, one thing I've been watching, and I've been bullish since early March, got bullish probably around 2,800, wrote it down, wrote it back up, was able to add. But what I saw was a lot of people who were bearish finally give up about a week or two ago, but they threw in the towel and they bought QQQ, et cetera, because they said, okay, big tech's working, I'll pile into that. So now I think you've got a lot of people who are bearish on the economy bought into that. And so one or two things is going to happen. They're going to get sold anyways, or this rotation occurs. And I think that rotation is the big factor is, hey, Amazon's going to do very well, but other people will come back as this turns around. Again, it's why energies, I think, stocks have done pretty well relative to the commodity. There's this turning on. It's going to start in certain states. We need to see some decent data of those states. But again, I think it's a 2 to 3 week time frame. We don't expect openings to, go like gangbusters this weekend.
I like the idea here that there is a possibility that the reopening situation is not as slow and depressing as the narrative. Because, again, as I've said here for a while, it's just everybody injects kind of their own bias, it seems like. Some people say, oh, well, nobody's going to go outside because I don't want to go back outside. But my point is I'm ready to go outside. And people are always like, well, are you going to go sit in a restaurant? Heck yeah, I'm ready to do it. But that's me. So there's this kind of inherent bias, I think, and we don't really know. It seems like it's just, you could just say, hey, it's a coin flip. So if you have reason to think it's going to be faster than what's currently baked in, you could see that leading towards a faster pickup of the economy. The question is just still, how much of a pickup does there need to be, and what are the signs you're going to be looking for to see if it's happening? Like, how are we going to gauge this, Peter? If you like banks and you're waiting for more signs that this is actually going to happen, what will you be looking for to go, okay, I want to add on to this trade?
No, I think some of it's going to be anecdotal, just looking around. Are people out there driving? Are people out there, spending money? I think you're going to be surprised by how good that is. Again, I sit here out in Connecticut, and every day we have to watch the federal government report, New Jersey report, Connecticut report, New York State report, New York City report. There is so much negative headlines out there. And I think if you start talking to people away from the tri-state area, it's not as bad. Start seeing that good data pop up. I do not expect full job recovery. So let's say we lost 30 out of 100 jobs. I think in this initial wave, I'm looking for about 15 to 20 of those jobs to come back over the next 1 to 2 months, which does leave a big hole. But I think what's going to fill that hole is going to be a real focus on infrastructure spending and supply chain repatriation. I think the president's made very clear that this administration wants to punish China, that they believe China is at least at some level of fault for our problems. I see supply chain repatriation as being the next job creator. It's going to get a lot of support. I think companies are looking at it and saying, hey, maybe we should not have all our eggs in one basket, so to say, particularly the medical industry, where we have things that are part of our national needs, for an emergency basis that we no longer produce. So I think that's where the momentum will start coming, where, okay, this reopening is okay. People will be left shrugging and saying, well, it's okay, it's not great. The next shift is really going to be, how do we grow from there? And all these trillions of dollars we're currently spending to keep people just afloat, I think we're supposed to keep spending that money. It's just supposed to be progressive at fixing the problem.
Hey, Peter, just real quick, is there a corollary trade in bonds as well then? Are we going to go back to that kind of Q4 setup from September where things surprise to the upside? Do you want to be short bonds?
You know, I think you want to, I definitely do not like bonds here. I think the 10-year Treasury, 30-year Treasury should be slightly higher yields. It's hard to fight when the Fed's buying that. But I would definitely be a little bit short that. And I think like a lot of other things you've talked about today, we've got to be very careful. And you can't take the signal that bonds are saying there's a big problem. No, bonds have a price indiscriminate buyer in the room. So bonds aren't sending the right signals necessarily that they would have. I do think bond yields should be higher. I think the 10-year should be at least at 1% and heading that direction. And get a bit more of a traditional risk-on trade, which we have not really had this time.
All right, Peter Tchir, head of macro strategy at Academy Securities. Great to catch up, Peter. Have a good weekend.